So welcome everyone. Welcome to this Market Thursday. It's June the 16th, and we're going to be discussing trading strategies during high volatility periods. As a quick disclaimer, this is not investment advice, so please do your own research, and I do not take responsibility for potential losses incurred. So what are we going to be covering today? Quickly, my background: started to work in the industry in 2000 as a cash equity trader. Worked for a hedge fund from 2004 to 2008 on the long-only product and on long-short product from 2009 to 2018. Worked for Infinity Capital Market that I rejoined in 2021. And since 2014, I've been mentoring and helping retail traders from all over the world, previously for another company. And since the 2018-2019 for my own company. So today, what are we going to be covering? As always, the situation across asset classes, stocks, credit, commodities, FX, doing a quick market review and looking at the recent performances. Then we're going to be quickly talking, maybe more than quickly talking about the FOMC meeting yesterday versus the inflation. We're going to be talking as well, not too much, but don't forget that tomorrow there is the option expiry. So interesting to see that, as always, the market is moving big during option expiry, and that is even more true this week. So take tomorrow's move with a pinch of salt and the volume as well, keeping in mind as well that we have a long weekend in the US. This is a 3 days weekend in the US. So there is room for some funny moves from actually now until Friday's close. Then we're going to be looking at the earnings and asking ourselves, is it still growing, and what is the implication for the S&P level and for the overall market. And then we're going to be covering trading strategies. So yesterday we had the FOMC meeting, 75 bips, so 0.75%, which was expected. There was an article on the Wall Street Journal on Monday during the sessions where clearly the Fed sent their intentions before the FOMC meeting. What you have is clearly an inflation that is going quickly, and all the central banks have to react. So for the last 12 or 18 months, they were hoping that the inflation was transitory. It is not transitory. We got inflation, CPI, kind of inflation above 6% plus across the world, between 6 to 12%. What is interesting is we had an acceleration over the last couple of days of central banks intervention. So as I said, FOMC, the Fed yesterday, 75 bips. Today we get the SNB, which is the Swiss National Bank, which went with a surprise 50 bips, so 0.5% increase to go to negative minus 0.25. Actually, for the S&B, this is quite something. And interestingly as well, they moved before the ECB. So the ECB is really, really late in the process, and something that we're going to see later. But looking for the catalyst now going forward, we're gonna have a big night. We get the Bank of Japan that is meeting. Expectations it's hard to have expectation with the Bank of Japan. So if you look at the GGBs, they have been moving on the expectation. Maybe something is gonna give. So far, the Bank of Japan has been staying put, which is, as always, the question is how long can you fight against the market? So big night overnight, which means that this expiry tomorrow is going to be interesting. As I said before, with the option expiry, trying to find catalyst. We get the bank's stress test next Thursday. Normally it should be fine. The banks should be okay, but that will tell us a bit more about what the banks could be doing in terms of share buyback and dividend. I think I read, what was it, Citigroup? I can't remember which big US bank was saying that potentially they will not be doing any share buyback in Q3. So that tells you about the color of the overall market. Then we get the end of quarter that is coming, even if it's only mid-June, but end of quarter with a lot of repositioning and rebalancing from the different indexes. And as well, next Friday, so in a week time, we get the Russell rebalancing. So this is something that we're going to be covering when looking at the trading strategies. Not something easy to do. It requires a bit of hard work, but the flows that are coming from this Russell rebalancing, and for any rebalancing like the some that we're going to have tomorrow in Europe and in the US, that means some stocks are going in and some stocks are going out. So as always, I would like to start with the asset classes performances year to date, which is up. Let me put the pen. So that was taken literally an hour ago. So the S&P down 20 to 23%. Now the Nasdaq more than 30%. So last time we look at the market, it was more than a month ago. I had to travel for pleasure and I had to travel for family, but we look at the 3,900 levels, which was where the market bounced a bit. So we went from 3,900 to 4,150, 4,170. And now we broke definitely this 3,800. And as we discussed before, the question is, if we go much lower, this is now a question of what the earnings are going to tell us. So the overall market, if you look at all those light blue of developed market, especially in the US, we are down more than 20%. Euro stocks is only down 20%, but if you FX adjust this thing with the euro being down 10% or 8% versus the dollar year to date, you get very much the same weakness as the US market. So the dollar, all that part means again, dollar very strong, which is something that I've been, I understand the risk of. I've been pretty wrong on that 4 to 5%. So I had some stop loss, which I was lucky. And the Bitcoin, the Bitcoin, you're reading the noise. Bitcoin down 50%, important level in terms of 21,000. I'm not trading the Bitcoin, just for the record. And WTI, really the big winner, 50% plus. So week to date, and this one is interesting because the market was expecting two things from starting last week. Was expecting first the CPI. So we had the US CPI on Friday, which was above expectations. And then the, let's say, the second effect of the US CPI, which was the Fed coming yesterday. So market really didn't like the CPI because not only if you look at the year on year, but if you look at the month on month, there is clearly strong inflation in the system. You can argue that there are now some signals that inflation might be peaking, but you will need potentially 2 to 3 months before the numbers coming down. And still, we are talking, headline number of 8% plus. So market didn't like it much, and that's an understatement. 8-10% for the S&P, Bitcoin taking a big dive, and the dollar strong. But actually today, what is interesting from the intraday session is probably you can see that the euro dollar, so the euro is a bit stronger, so it's now at 105 versus 104 in the morning. The yen is strengthening a bit versus the US dollar. Is it just like small reversion to the mean before the Bank of Japan? This is possible. So again, next 12 to 24 hours are going to be very interesting, both for the Bank of Japan and the option expiry. WTI down 5% on the week. I think the XLE, as we're going to be covering just after, is down 10%. So the winners have been coming down a bit and have been actually underperforming the overall market. That tells you a bit as well of the concerns on the world economy going forward. When WTI is coming down, that tells you that the world might be slowing, meaning you might need less oil. As I've been discussing over and over during several webinars, for the oil demand to come down from one year to another, you literally need the world to go into a big recession. Other than that, WTI consumption is growing roughly by 1% every single year. Next slide. So this is the one that I just mentioned, looking at the year to date and the week to date sector performances. So on the left-hand side, the picture is similar to before, where the XLE is the big winner, but actually the loser are getting even more, are losing even more. So we are literally stretching to the left-hand side, which is completely understandable. Looking at the overall market, that is down 5–10% since we spoke a month ago. Week to date, as I said, that is the part that is interesting. XLE down 12% and really underperforming the overall market, which is here, so 8%. So think that here, this is your, if I manage to do it, so this is your benchmark. And then here you'll have the outperformers, and everywhere here, that will be the underperformer, just on the week to date. But as the market is moving big time and violently, we need to look at those different time frames, how year to date, 3 months, 1 month, because the market might be telling us different things. Next slide, for the bonds and the VIX, I didn't put the stocks week to date because, you know, literally we had too many stocks that have been hammered. So bonds up 1.8% on the US Treasury for the year, 26 bips for the week. Actually, there is as well a bit of a reversal since yesterday. So we went to 3.4, 3.45. On the US 10 years, we were up to 320. So some assets intraday today are telling us that there is a bit of less of a panic, but the equity market is feeling the pain. The VIX is at 32%. So many questions before today, where the S&P was down 3%, and actually the VIX was flat on the day. But that's not really a surprise in the sense that if you look at the puts versus the calls, the put call, actually, if you look at the Russell 2000 today, there are like 4 times more puts than calls. So what we used to have before on the way up, when people were buying a lot of calls, actually now there is a lot of puts that have been bought. So there is a kind of, there is stress everywhere across asset classes, but there is no panic yet, which tells us potentially, I think you need to look to take a step back, looking at the big picture. We know that in 2020. The central banks put a lot of money into the system. So that's something I said a month ago, 2 months ago, 3 months ago, 6 months ago. So don't be surprised that there's a big reversion to the mean because we did something crazy or something that the central banks had to do. They put in the US 5 trillion, in Europe 5 trillion. And now we need to reverse those things because there is inflation. So look at your charts on the long-term basis. This is something you should probably do for the S&P, for the NASDAQ, even if those moves looks quite huge. Actually, we are just reverting to the mean. And the VIX is for the time being is telling us the same thing with, you know, we are obviously in a stressful situation across asset classes, but we are not yet into the 40, 50, 60, 70% VIX. So it's a kind of, the flows are going out, people are selling, people have been protecting themselves as well. And you have a massive reduction of balance sheet, of exposure, of gross exposure. Okay, do I have another slide? Yeah, before going into technical analysis, a few charts. So here, this is the high yield I'm using from the St. Louis Fed website. So this is the Bank of America US high yield, and that tells you that the stress in in the credit market is literally spreading into high yield. When high yield is not feeling that well, that tells you as well that potentially there will be defaults coming for US companies and companies across the world. So the first effect is you have panic in the credit market. The second effect is you're going to see people going under. And as they are defaulting, you need to have higher yield. And as the Fed and as the central banks are not controlling that much the yield curve and not controlling that much the credit, it makes those things really plummeting. So this is the same chart here from Bloomberg. European spreads. So here, this is another stress in the market for those who have been trading for more than 2 or 3 years ago and thinking that, you know, the market is only going up. Same with Bitcoin. Now they realize that you need to be looking at macro. And one of the topics that we had 10 years ago was the spreads in Europe. So here we are looking at the Italy versus Germany. So the Italian 10 years versus the German 10 years, which is the BTPs versus the Bund. And as you can see, recently there has been a widening of the spread. And that tells you that there is stress in the European credit. If you remember, the ECB says now we are not going to do quantitative easing anymore. But that will create issues, especially when the BTPs are now yielding 4%, and you do have a lot of debt. You might be potentially looking for trouble, keeping in mind that there's two things. The first thing is the ECB is not on the bid anymore, meaning that they are not buying the BTPs. And secondly, most of the BTPs are owned by Italian banks or by Italians. So that means Italian banks, if they own 60 billion or plus, and I think overall the Italians own like 600 billion, and the BTPs are down 10 to 15%. I think it's 15% year to date for the banks. That represents more than 10 billion loss if you mark those things to market. So I just wanted to give you stress. If you are following these webinars, it's probably that you are aware of all those stress in the market. Clearly, stress in the credit market, stress and effects, stress between the preference and the Bund. There is not yet like it's not yet the end of the world, but the problem that we are facing now is central banks have been saying we are not in the bid, not at the bid anymore. We can't do quantitative easing. And that means the market is just selling all the assets slowly but surely, sometimes a bit quicker than usual. And that's what happened over the last week, because we moved down 8% across equities. And actually the credit market has been moving quite a lot. But similarly, if you look at long-term picture, if you look at long-term charts, it's not like we are not reverting to the mean. So first thing that I want to mention for technical analysis, so when I say technical analysis is price action and what is happening. So here we are looking at the dollar yen. As I said, Bank of Japan meeting overnight. So everyone is looking at it. Any traders that I know will be, and across asset classes, will be looking at the Bank of Japan overnight. So is it a question of being awake? I want to sleep a bit, so we'll see. But you see the weakening of the Japanese yen that we discussed before. Why? Because the Bank of Japan has decided that there is no inflation, that they don't need. They can continue to put to have the Japanese 10 years at 0.25%. And that means there is no carry trade and weakening of the Japanese yen. That will be really, really important of what they're going to say if they can continue. For the time being, they have been very stubborn, but you can argue that even the S&P did something, and I think very quickly the ECB will have to do something. Looking at stocks, looking at indexes, looking at the S&P, For those of you who are joining today or watching later on YouTube, I'm using the ES, which stands for the S&P futures. In yellow, we get the 3,900 that we discussed a month ago. I said that there was a good chance that we will bounce on this level. We have been bouncing, and we discussed that if we go lower, that means potentially, first, it's looking pretty shite, and as well that recession is coming and getting closer. In terms of next level, we discussed them. There is 3,400, 3,200. We're going to be looking at the multiples as well. Doesn't look very nice. One of the chart that I think is the most easy to read is the Russell 2000. So Russell 2000, I've been saying over and over that, and I've been on record since then, since here and from here as well. Now we are testing the support or close to the support. So there is a bit of hope, but the Nasdaq is not looking great still. As I said like 10 minutes ago, it's just like an unwinding of books, an unwinding of balance sheet. So we are coming down with sometimes quicker than usual, but overall there is no panic in the system. The high yield, looking at the ETF, so this is the one. So you see the picture here, which is normal because first the credit has been absolutely hammered, but there are talks, there are fears that it is spreading into a high yield. If it's spreading into a high yield, that tells you that the economy is obviously not looking nice. But more interestingly, when the central banks are really doing intervention is when the credit market is not functioning. And to give you a bit of color, normally every company, almost every listed company will be using the credit market to do new emission, and we are talking, you know, overnight, 1 month, 1 year, 5 years, 10 years, 20 years bond, depending. And what has been happening, what we started to see from Monday onwards, is actually some companies are withdrawing and not putting new bonds to emission, meaning that there is stress in new emission. The Fed doesn't like it. They will be looking at it definitely, and I think this is a part of the market. If you are hoping that the Fed or any central banks will be intervening again, that is because there is some plumbing, some functioning that actually is not working anymore. I don't want to be spending too much time on this chart because I want to be a bit lazy today, but so a 10 years yield, there is no technical analysis on it, but that gives you the color. We had a bit of a relief, and then we move really big since the CPI. As I told you today, there's a bit of reversal intraday. We went from what was that, 350, and now we are 333, so 17 bips, which is not that much these days. But in terms of risk on, risk off, some reversal, intraday reversal on the US Treasury, on the Japanese yen, but take everything with a pinch of salt. Before the Bank of Japan is like, you know, I think it's the weak hands and some reversion to the mean. DXY, that's the same, a bit of reversion to the mean today. But overall, you see we made new highs. I'm not going to give you the Bitcoin chart. The Bitcoin chart, you know, if we don't hold the 20,000, I think it's going to be to 10,000. Euro dollar, finally, euro dollar up. So the 104 level, it's still holding. And that's a similar level that we had. When was that? That was in 2017. So strong level at 104. If we don't have the support as 103.50 or 104, then we're going to be making the headlines during the summer with the parity. So that is more or less what I have for for the technical analysis, you can be looking at any single charts for stocks. They more or less look all the same. I mentioned before the XLE and some sectors, but that's probably what you should be doing, looking at the 11 sectors versus the S&P, so looking on an absolute basis and a relative basis. And today I think what was interesting, and I just want to come back into something that we discussed in the with the community, looking at the economic cycle. So, and that's funny because, you know, that is something that I've been pushing a lot in the 4x4 video series, is if you don't understand the economic cycle, and if you don't understand which sectors and which industries to play, you're going to be struggling. And clearly, one of the things that have been happening over the last 10 years and over the last 2 years is the central banks, by putting a lot of money into the system, have been distorting the economic cycle. So as a portfolio manager trader, I have to say that I struggle a bit over the last few years, sometimes to get the picture, and even so, and even as well to do some P&L. And now I think it's back to reality, where we all knew that in 2020, when the assets were going through the roof, that there was a mismatch, and even in 2021, between what was happening and where the assets were going. And as always, you're just hoping that it's going to last and you're going to be carrying these things. And what I can tell you from my part as an educator is most people, I will say, you know, a big chunk of the retail traders are coming back to me, you know, through Twitter, through chat, and saying, you know, Greg, I know you told me, you said I was watching the webinars, blah, 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 and I lost all what I made, and I lost, you know, probably between 50 and 100% of my P&L afterwards. And we are talking people that, you know, traded the Luna, traded the Bitcoin, but traded as well, you know, stocks, okay, a lot of stocks. So in other words, if you don't understand the cycle, if you don't understand the economy, the macro, you're going to be struggling. And I'm saying that as a person who started, you know, trading the tick, and I have no idea about the macro. By understanding those things, you are going to be better. So very similar slide that the one from last month. Just added the beast from last month. So US inflation still very hot. So the core CPI, which is here, 0.6 months on month, and 6% year on year. So very strong number. Again, there are some let's say leading indicators that are telling us that inflation is probably peaking now. It's going to be taking another potentially 2 to 3 months to come down, because services are a bit slower to pick, but the rest, we are talking housing, we are talking some commodities, have been coming down. So we get the pick. So some will say, oh, because the Fed is doing and the central banks are intervening, when actually inflation is coming down. But actually look at the numbers. We are talking inflation again that is at 5% plus. So it's not like this inflation to 5-6% is suddenly is going to go down to 2%. So core CPI still very strong. So what we need to look forward, and that's something that I discussed a month ago, and I want to discuss again, is the market is always driven by different factors. Clearly, the market these days is looking at inflation, so we are data dependent. Actually, for once and for all, we are data dependent. So that means as traders, as portfolio managers, we need to know when are the next earnings, the next data coming. So end of this month, 30th of June, we get the PCE. The 1st of July, we got another indicator, which is the ISM, prices paid. 13th of July, the CPI. And then on the 27th of July, we get the FOMC. So those are some indicators from inflation. We know that the Fed is mostly looking at the PCE. So that will be your headlines. If you don't understand that, actually, it was probably a reality check, because look at when the market started to move. The market started to move last week. one day before the CPI, and since then we have been going one way. So keep in mind, again, OPEX tomorrow, option expiry, so there is a bit of distortion of all of this, and it's quite something that the Fed is still doing those quarterly meeting during OPEX week. Just a bit of cartoon here. So the Fed, trust in me, we will have a soft landing. So on one hand, for the last 12, 18 months, central banks, the Fed, have been telling us, don't worry, it's transitory, there is no inflation, we're going to manage to do a soft landing. So trust in me. And now they are telling us, you know, keep on trusting me because, you know, it's going to be a soft landing. So I don't think that the markets now is that stupid anymore. The Fed has been pretty wrong so far with inflation. They have been very slow to react. I think if you look at last November, Fed Powell had to adjust because he had a call from the Biden administration saying, you know, I got the midterm elections coming in a year time, and we are all going to be looking completely stupid with that kind of inflation. So if you are looking at webinars, we discussed those midterm elections. I think it was the start of the year, and we said, you know, maybe either we should come back in a year time, or actually, if you want the market to be bottoming in the midterm election year, most of the time it happens in September, early September. So far, it's not that different. There are many stress factors coming into the summer. We are talking about, you know, I haven't even mentioned, you know, the Russia, Ukraine, WTI, which potentially could go to the roof. So there are many things, but the Fed can try to trust in me on the day, which was yesterday, but then reality check and feel like, you know, you go for a party on the Wednesday, and actually when you wake up on the Thursday, you're big hangover, and that's what has been happening these days. So FOMC meeting. So that was from last from the start of the week. You should be looking for the next FOMC expectations, and that you can find it on several websites. So let's look now at earnings and see if earnings are still growing. So this table is from JP Morgan, from one of their strategists, which is called Dubravko, and we are talking on the left-hand side, the multipliers of the S&P for the P, and here we are looking at the earnings. Okay, so depending where are the earnings, so that's your earnings, and depending where is your multiple, you end up with the level of the S&P. So in other words, if I take $235 for the S&P 500 earnings and I multiply them by 20, I end up with 4,700. Okay, so more or less, this is what we had at the start of the year. Start of the year, consensus was at that 235, 240 for the S&P earnings, and people were saying, okay, what about we use 20 to 21 times? The first thing that has been coming down is the P, is the multiplier. Sorry. So the multiplier used to be into the, as I said, you know, 21, and we say we're gonna stay. The only reason you're going to stay around the 20 times plus is if you have cheap financing. Okay, why? Because when there is cheap financing, you can be using high multiplier, but there is always an inverse relationship between interest rates and P ratios. So as interest rates went up, and we are talking, you know, 1.5 to 2% on the year, P has been coming down quite a lot. So if you think at the 25 years average, that is 16.85 times. I think when I build the 4x4 on a much longer time frame, we are talking potentially 14 times P. Okay, on average since forever. So if you look a bit of how you call that, I think it's a chart. It's a chart porn, or looking at you know, a bit of a dodgy chart. Here we are looking at the S&P in white versus the S&P, sorry, the P of the S&P versus the US 10 years, okay? And the US 10 years will be inverted here, okay? So we get yields going from 0 to 5%, meaning when yields are going up, here, the P is coming down. So even if it's a bit of a dodgy chart, you get the picture that overall, when yields are going up, P are coming down. So what we had so far until 3,900 is literally yields going up and the multiplier coming down. Okay, so if we go back into the table that we had before, the 235 so far of the earnings stayed the same, but instead of using 21 times, we use 17 times, okay, or 16 times. Now the question is, we're going to have the second wave, the second derivative of it, which is, are we going to have earning compression? If you're going to have earnings compression, then you are in trouble. Okay, so 235 times 17 or times, 235 times 17, you end up at 4,000. At 230, you get 3,900. Okay, so this is what we had a month ago. And as I said, during the webinar in May, I said, if earnings are coming down, then we get the second wave down, and we are breaking low. And actually, this is what the market is now pricing. The market is now pricing that we're not going to have $230, and we're probably going to have less. So one of the positives that we had in the earnings is because oil and commodities have been so high, XLE, materials have been outperforming, and actually the earnings have been pretty good. But meaning that, some other part of now the economy are going to be struggling big time. So now let's look at the overall picture and look at the S&P 500 earnings. So for those of you who are watching today, every mentoring session starts the same. We look at the earnings over time. So we look at the cycle and we try to understand what is the overall growth of the S&P earnings. And maybe, on the first session, you don't understand, and then slowly but surely you understand why I do that. And if you're watching today, and if you've been watching the different webinars, you understand as well what is the picture. So if you look at 2019, 3% year-on-year growth. 2020, minus 22%. 2021, 70%. And now we are expecting, so that's the expectation for 2022, 7.7% and 10.5%. So this is where the consensus is still standing. If you look at the overall earnings growth of the S&P over time, we are talking between 7 to 9%. So guess what? As the analysts are pretty lazy, they're going to say, oh, I've been using average since forever, and apply that over the next couple of years. To have those kind of numbers, on one end, you can argue that the economy needs to be growing potentially 2 to 3%. Okay, so that's your GDP, or that one of the sectors have been doing pretty well, which is the XLE, or you keep the margins at very high level. Okay, margins at historical level much higher than usual, which is going to be an issue now. So now, big question is, S&P, let's say at 3,800, what is price versus the average? So if you take 3,800 divided by 17, which is your multiplier, you end up with 223. 223, guess what? This is what you have from the consensus. Okay, so not that different from 224. In other words, so far the market is pricing a 7% average earnings growth paid 17 times. Now, you can do the same calculation with recession, meaning earnings compression. So let's assume that you go back into a bit less than 2021 earnings at $200, and you multiply that by 17 times. Why you use 17 times? Because yields are not at 1% or 0.5% US 10 years, but it's at 3 to 4%. If you use the same kind of number, you end up at 3,400 on the S&P. Okay, so something that we discussed last month, we can go 3,200, 3,300, 3,400. And that means you have some recession, but it's not like crazy recession. If you look past recession and earnings compression, we are talking at real numbers coming down. So you can play with that. That is something that I strongly advise you to do. That gives you an overall picture, not only based on technical analysis and charts that you will probably do when you start trading, but overall, you know, if you are happy to pay that kind of thing in the cycle. Let's jump now into some trading strategies during high volatility periods. I know that after, you know, market going higher and higher and people thinking that the volatility must be at 15% or the VIX always, now we are facing a different scenario. So I just wanted to look at the distribution of the S&P based on the VIX. So if you get so this is the case one here. If you get the S&P 500 at 3,800, which was the price, unfortunately, let's say 2 days ago, and the VIX at 30%, those are the implied move on the S&P 1 day, 1 week, 1 month, 1 year, with 68% chance and 95% chance. Now you do the same with, instead of having a VIX at 30, you do a VIX at 15, okay? Which is, you know, the VIX at 15, this is something that we had in 2018, 2017, we had even lower, but that gives you clearly a different picture between, on a month's time, here we move from 34 to 44, and here from 36 to 40. So as you can see, I mean, you don't need to be a genius, but that's just to confirm that with numbers, you're going to have much wider move. In other words, if you don't adapt your positioning to this new reality, guess what? You're going to get killed. And I know that, you know, most of people that come to me that have been killed didn't listen to this volatility. So they say, oh, you know, it's a different story. I look at fundamentals, blah, blah, blah. But then they didn't realize, or they realized, but didn't adjust their risk management to this one. So similarly here, I'm using the Bitcoin daily ATR. So as you can see, when there is stress, your daily ATR, which is more or less your daily move, is not going to be moving the same. So between Bitcoin moving by 4% and Bitcoin moving by 8% every single day, that is clearly not the same picture. I can give you the same with, so this is for Apple, where we're going to have 4 to 5%, whereas recently we get 2% intraday or daily move. So just by looking at the VIX, looking at implied volatility, looking at tools like ATR, you will have to adjust your way of investing. If volatility is very low, you can have a lot of gross exposure, you can have a net exposure, you can have, the moves are going to be slow to happen. That means you are an investor. You can do easy 1 to 3 months, you can do longer than that. When the VIX, when volatility is just spiking the way it is, and the way it has been, at 20%, 25%, 30%, then suddenly you become, instead of being an investor, you become a trader, okay? And that is what is the hardest part in this business, is to adjust to the new market. So being an investor is different from being a trader, and that requires a different skill. So here, this is kind of, you know, paradise market for traders. And this is part that when I built the 4x4, I really wanted people to benefit from, to a certain extent, to my experience at both, you know, hedge fund and prop trading. When you do prop trading, you do mostly, as the name is saying, you do trading and you do short to mid-term. And that means you benefit. You're always looking for volatility. You're always looking for a catalyst for things to move. So here, in the community, this is something that we discussed almost every day, because the market is more a trader market than investor market. And I think as we are moving these days, we have to be moving from the pure investing, as we don't have much visibility, we need to be looking at special situations. Okay, special situation is a big word that is inside special situation. There's a bit of everything, and actually for newbies and retail traders, it's pretty hard to handle with. But some of the examples that we can have, what you try to find these days, and as always, is try to find a catalyst. You try to find a story when you buy or when you sell something. These days it's pretty binary. Okay, so if you can be trading the future, but stocks are going up or down, adjusted from the beta more or less. So what we want is to be finding those special situations where we get a catalyst. So naturally, companies come with a special situation. We are here. I give you some examples. Spin-offs, meaning when a company is spinning off one business from the mother business. The lockup expiry, meaning there could be new shares in the market. Dividends, that has been very true for the last couple of months in Europe. In Europe, there is a lot of rights issue. So rights issue is very much a good tell of where you are in the cycle. When everything is going according to the plan, when you get access to credit, companies don't need to refinance or to restructure their balance sheet. And guess what? In Europe, because we are in the middle of a shitstorm and companies are still very much leveraged, there are more and more rights issue. Rights issue, I can give you an example. You probably all know the company Air France. So Air France just did a rights issue. There was another rights issue in France. And I give you some example because there are a lot in Europe these days, less in the US, because this is something that is less common in the US. But clearly, this is one of the special situations. You need to look for catalysts. Similar, one that I like very much, that I always discuss with the community, is the index rebalancing. So tomorrow, for instance, we're going to have the index rebalancing of several indexes in Europe, which comes same as the option expiry on the third Friday of the months of March, June, September, and December. But for next week, actually, there's an interesting one special situation, which is the Russell rebalancing. So we're going to have the Russell index reconstitutions. So for those of you who are trading the US and always asking yourself, about mid and small caps, that is really something to be aware, which it happens on the fourth Friday of June. So to give you an example, so this is really a big number. On 25th of June last year, 186 billion was traded in trading volume in the last 10 minutes, I think, of the US market. So what I strongly advise you to do is going onto the Russell website, and that gives you the chronology of what's going to happen. That was last Friday, and tomorrow they're going to give you the deletions and adds into those indexes. Why is it really important? If on your watch list, or even if you're on a portfolio, you have stocks that could be deleted or added into those indexes, I can tell you that the underperformance on the outperformance could be extremely massive, especially in the market, which is looking for where the liquidity sometimes is a bit dodgy these days. So next Friday, if you get a portfolio and you get a lot of small and mid caps, trust me, on the last day, on the last Friday, is going to be pretty much a lot of potential big movers. So quickly for next week, energy and consumer discretionary have been dominating the move up from the Russell 2000, which makes sense. Why? Because energy was and is for the year still pretty strong, and consumer discretionary, because when they started to do the screening, it was still pretty strong. So I'll leave you read that one. It's going to be on YouTube later. That is really important. If you look at those numbers, we are talking 12 trillion of investors that are, let's say, indexed to those different indexes, meaning that in the next week, from now until next Friday, there's going to be a lot of potential movers. something as well that I discuss every 3 months, and I discuss with the community today. You're gonna have, as I said, the option expiry tomorrow. So check when your markets are expiring. For instance, if you look at Europe, Italy is auctioning at the open. Same with Switzerland, whereas in the UK it's going to be 2 hours after the open, and Germany is going to be during at 12 at lunchtime. So again, here's some examples of companies that are going in and some companies that might go out. So moving up, those are the names. Look at those tickers because they're going to be, again, impacted by the move. So when we are trading strategies during high volatility periods, those are the things that you need to have the infrastructure. It's very different from trading, let's say, as an investor for 1-3 months or plus. But what is really important, I know that these days people are very confused because for the last, especially in 2020, 2021, all those retail traders were following those gurus, and they thought that, it was super easy. And I can tell you that in the next, let's say 2 years, I'm going to have a lot of people coming to me and say, look, Greg, I've been absolutely destroyed. I bought education, I bought X and Y, and I lost all my capital. So now I need to wait before trading again. So we know, for instance, in the crypto world that some, that were saying a few months ago that they were irresponsibly long are now saying that they will be increasing their position very soon. So someone has to explain to me, if you are irresponsibly long 50-60% higher, how can you be increasing your position? Because that means you are all in way above. Similarly, and that's unfortunately for people, that have been investing in innovation funds, so-called, or, following people on different several TV channels. But, the same thing that I've been saying over and over, and I'm on record for the last 12 months, and I know at one stage it's going to be making all the headlines, is since 2019, unfortunately, some of you have been trading with options. And some educators have been telling you, it's fine, you're going to be making 200, 300, 400% returns and having crazy concentration. I can tell you that it's not better than saying, you should be putting all in crypto. It's going to end in tears. I know what's going to happen. They're going to be saying, oh, you didn't do your work. They're going to change the story. Be very aware. When you trade high volatility, like we have these days, it's all about the risk management. So another part that is really important is being cash when market is very hard, very difficult, is really a good option. And I'm on the record this year, probably since January, February, saying you need to reduce exposure, you need to have some cash because the market will be really hard. So I had the first move down. And so I've been saying that for months, you need to reduce exposure. There is, don't believe the hype. Don't believe that, trading is always easy and you always need to be invested in doing something. So understand the basics of the risk management. So 2 things that I think are important today that we covered is where you are in the economic cycle. That you don't need to be genius, to be honest. Don't believe the hype, but do a bit of work. And the second thing, as a starter, the most important thing, and probably I end up 80% of my webinars with it, and it's probably boring. It's all about understanding the basics of the risk management. So look at the concept of gross exposure, net exposure, industry exposure, stop loss. That is something that is explained in detail in the 4x4. You don't need necessarily to go with the 4x4, but you just need to do it. There are some other products, there are some other people that can do it, that can help you, but please do it. It's all about, making sure that you limit your downside. Quickly, what I do on top of those webinars that I put on YouTube. So we have a trading community. I feel like it's growing. I feel like it's getting better. Why? Because I think people are good on that trading community. So there is no bullshit, there is no crypto, there is no options like crazy trading. It's quality people, and we are growing. So as you can see on the left-hand side, we are talking macro, long IDs, short IDs, risk management, infrastructure, sources, pub, everything that I'm doing during the webinars. The second thing that I do is the video series. So the 4x4 that I created a couple of years ago, based on my now 20 years experience, 20 years, my God, 20 years experience in this industry, long only, long short, hedge fund, prop trading, and based as well on my previous experience on working for another company. And I do the mentoring. So mentoring is one-on-one sessions. I like it very much. Similar to the community, I'm lucky enough to have like good mentees, so that helps a lot. And actually, for the people who subscribe in the past to the 4x4 and the people that are doing the mentoring, don't forget that next Saturday, and it's free. Okay, next Saturday, on 25th of June at 1 p.m. UK. We're going to have this mentoring session for the trading community. So this group mentoring session. So for those of you who are watching now or later on YouTube, please send your IDs to me, and I'm going to be choosing 2 or 3. And as we did a couple of months ago, we're going to be discussing these IDs together. So that was for today. If you get any questions, you can reach me on the website. I'm on YouTube. I'm on Twitter, I'm on Facebook, I'm on LinkedIn, the whole usual stuff. If you like those videos, you can say that you like it. You can forward. If you get friends that are struggling, it's good to be growing the community. In terms of overall market, I gave you, I hope, some of the catalysts going forward and the overall picture. This is what we're trying to do every 2 weeks or every month. So I hope it helps, and I hope to see you soon. Thank you, everyone. Bye-bye.